Hey Chris, what's up, man?
What's happening? How are you? I'm good. How's it going?
Oh, it's going great. This is Brian Jones. I'm here with Chris Hood, professional trader, world's most interesting man. Yes, talking about
I think we're going to
jiu-jitsu.
have to dilute that a little bit. According to my son, I'm the world's most brittle geriatric. So, we'll have to change the moniker a little.
Said that he is convinced that he's gonna outrank you. Is
Oh,
that
yeah, totally. Told him the other day, I said, Tom, are you ever going to see your dad in a black belt? And he was absolutely convinced that I wouldn't. So I've made funeral arrangements that if I die before I get my black belt, I needed to be thrown into the oven at the same time as me. So at least I was a posthumous black belt. I define myself as the geriatric elephant with no athletic ability. So we'll see where that goes.
I think that's a good system. You could come up with that as the system, the elephant guard.
I have the donut guard. It was developed during COVID, and it's basically it has the dynamics of a sloth. So if I can just sort of slide on someone and just sort of camp out on the side, yeah, my jiu-jitsu is very much a boring event. It's glacial at pace and not designed for viewing pleasure. I'll tell you that now. I mean, if you're ever at a tournament and I'm in a match, just go somewhere else. I promise you'll have a lot more viewing pleasure watching someone else do
You'll
this.
still be in the same spot when you get when they get back.
Oh man, I was looking at this latest tournament here. I was scrolling through the competitors looking for my weight division. If I wanted to get two golds, this would be the best weekend for me to do it because I just have to drive to the venue, pick up the stuff and leave. There's just no one my age now. There's no one my weight. I was thinking, should I drop weight and go find a match? And I was like, bro, you're 49. What are you doing? Just don't do that. Like, get the gold medal and move on, man.
Have to go to those bigger tournaments to get anyone in.
Yeah. Well, I do hold some records though. I am the only person ever to have won a silver medal in a one-man division. So they'll look at me and go grab your silver medal. Like, but there's only one guy. Yeah, but your shrimping sucks. So, your forward roll looks a little bit, terrible.
I thought maybe they made you like line up and then, like in judo, sometimes they'll do the thing where it's like they make you get on the mat and then they raise your hand, but then you start cursing at the ref and get this. You're like,
why didn't you give me that advantage for standing really nicely on the side?
You start fit and then you get disqualified from the match that they forfeited.
Well, I'll be honest. I've been in situations where referees have made some really bad decisions, and I went up to the ref at the end. I was like, "What? Come on, man!" And he's like, "I'm sorry, man. I was on the wrong side of the mat." I was like, "But I was doing all this micro work on the guy on this side,
Yeah.
Yeah, it's going to be interesting to see how many students have actually stayed in the sport. Because in Canada, when they shut it down, a lot of gyms got closed. So very sad to hear that a lot of gyms closed. So it's going to be quite interesting. But this tournament is just happening too soon after the gyms have opened. So I expect the hospitals to be pretty busy on Sunday.
Right.
Lots of geriatric injury. And the problem at my age is a lot of the guys in my division around the world are TRT replaced athletes, right? So you're going up against guys. I don't know, man. I'm not into that.
Get on the juice, man. You gotta get on the juice.
I don't know, man. I whenever I've trained and weights and trying to lift up, I just don't put on muscle. I mean, I'm 230 pounds, and I look at guys that go in the UFC, and it's like weighing in at 220 pounds, and this guy's got arms the size of a car, and it's just, I look at myself and I'm like, what the hell? How did he get that? And I don't, I got the short stick. I really got the short stick.
You're a pro athlete. You're a pro trader. So like, tell you're great at what you do here.
I'd rather be great at a Kimura, man.
Well, so what about this this market? Is this are we gonna see this bounce, or is this kind of a dead cat bounce kind of?
No, I think it's gonna happen. This is normal. And this happened last year, if you remember. September, October are always pretty rough in terms of the sort of seasonality, the liquidity in the market. It's the end of the third quarter. It's, there's a lot of rebalancing that goes on around this time. You've got the futures roll on the contract. So there's a lot of abnormal volatility in both directions, right? up and down. What you've been seeing over the last couple of days, a little movement up, a pop up gets pulled back, a pop down gets pulled up. It's just difficult. It's difficult to sort of gauge any sort of directional strength. Like, is this going to be sustained? Is it going to be a movement to the downside bigger? We haven't moved much. This is the thing that a lot of retail traders fall into the trap of, is they look at recency and they go, oh my God, 5 days in a row, market's shitty, we're going to now stop trading completely, and they miss the bounce. So what I'm looking at is I'm going, okay, we saw this last year, we've seen this now, we knew this was coming. Back in June, I was saying to clients, guys, prepare for September. This is how it works. You know, if you're not preparing to reduce your book size, reduce your positions, trade more with cash, you know, not be so aggressive at this time of the year, you set yourself up for a really good fourth quarter. You know, we get that Christmas rally. It's not, you know, every Christmas rally is different, but they happen. There's a degree of, you know, October, November, end of October, November, December, sort of up to February. That's where you make the bulk of your money. If you go back and look at your trading data over the last maybe 5 to 10 years, you'll see 60 to 70% of your gross annual trading income comes in those 5 months that happen at the end of the fourth quarter of the year one into Q1 of the second year, right? So that's where you have to maximize. The problem is this: many retail traders have not traded long enough to see the pattern of the season. So they trade every single month as if it's the same. So whether it's January or September, they behave the same way. They're not recognizing the shifts in the market dynamic. They're not looking at liquidity. They're not looking at events that are happening outside of trading that will generate volatility. So they trade with this mindset of, oh, it will always go up, okay? The market naturally works on a rhythm of pullbacks, right? So once it gets extended, it pulls back. Then it gets extended and pulls back. The challenge for a lot of retail guys is keeping enough of your profits that you make in that fourth quarter of the year, the Q4 and Q1, so that you don't give it back in Q2 and you don't spend your summer trying to make back the losses that you incurred in that Q1, right? It happens every single year. It's an incredibly frustrating cycle for a lot of traders, because they look at the calendar of 12 months and they go, right, I'm going to make money in these 12 months. They don't see the overlaps, and they don't have the perseverance to actually trade a plan that allows them to survive the summer, get through Q3. Q3 is always a bad quarter, right? But you make up your money in Q4 and Q1. That's how it's supposed to work. It's supposed to be Q4, Q1, make the most of your money. Q2, trade the chop, keep the profits. Q3, you want to try and maintain some degree of cash and go high in cash, minimize your trading, reduce your levels of positions, and then Q4, do it all over again. That's the cycle of the year. Unfortunately, perseverance, planning, and all of those things are not characteristics that are normal for people that have got A, lots of money, or B, have, you know, just jumped into trading as a, you know, thinking it's easy kind of thing, right? So again, it comes down to that advertising. This is not an easy game, and it takes a lot of experience to work out these patterns. So, you know, that's,
It's a lack of perspective. I mean, you have to go through a couple of years of market cycles to kind of like understand.
Yeah, you've got to lose a bit to know how to make a bit. That's the way. But I don't see how losing, like really blowing up your account and being a fool, is necessary. You can avoid that completely by just following a proper plan. You know, knowing the strategies that you're going to use, knowing the stocks you're going to trade, knowing the setups you're going to trade, that takes away 90% of your trading risk if you know what you're looking for. If you're just randomly aiming at stuff because your buddy at the gym told you to do something, you know, buy this meme stock or whatever it is, you're not going to survive. You will eventually give all the gains back. I was watching, I go on Wall Street Bets every now and then just to get a good laugh. And you look at some of these guys where they use losses like badges of honor. It's almost like you get stripes, you know, you get ranking. It's like a military system. The more losses you have, the higher you go. And I watched one guy, you know, dump a whole lot of money on put options on a stock that just by looking at the indicators, you could tell it was going to go up. And he lost on that trade. And about 2 days later, he posted another meme or whatever it was, saying he was doubling down, and he lost on that one again. And then a couple of weeks later, he did another trade. And again, it just came down to lack of understanding of the fundamentals of trading. The problem is when you're in a group of people where the blind are leading the blind, I guarantee you'll lose. The most successful traders are the ones that don't get in chat groups, the ones that sit on their own and have a plan. They know what they're looking for. They trust their analysis. They don't need, you know, Jack from the 7-Eleven who happened to bump into you while you were picking up a 6-pack and a packet of chips tell you where to put your money. I mean, that's just crazy stuff. So, you know, we're coming up to Q4, and, you know, when you want to prepare for that sort of market condition where there's going to be this, you need your cash to be high, you know, so don't chase trades in September knowing that you're going to need that cash in October, because if you lose in September, you don't have that cash.
I'm going to stay small in the volatility.
Nimble, have lower expectations. I mean, if you remember, we were averaging around $3,000 to $4,000 a week going up to the November timeframe last year. In November to February, we went up to $12,000 a week on average. We tripled it because we planned to do that. So we know our goal for the year is a 52-week average for me, you know, around $3,500 a week. That's what we want to average over the year. And during the year, we're going to have weeks where we make 15, 20, 30,000, and there are going to be weeks where we make 1 to 2. We know that because of the conditions that exist in the market. So as we start building a plan to take into account how the market's going to change over the seasons, that needs to be taken into account. You're not going to go in a week where we know that it's going to be a low week and try and force trades. You try and like stuff them into the market. You know, it just, you never win that way. So sometimes you've got to have expectations of, look, there are 52 trading weeks in the year. Some weeks I'm going to make a lot less than I planned, and some weeks I'm going to knock the ball out of the park. I'm not going to let one week where I've got less than planned define my year. It doesn't define your year. You have 52 opportunities to win. And if you were, you know, 46-6 at the end of the year, do you really care? No, you don't care. And if you look at your average, you'd look at it and go, geez, my goal for the year was 3. My actual for the goal was 8. I did well, even though I had 5 weeks that were pretty crappy, and those were normal because the year before it was the same. So data is really important. Like, if you don't track the metrics that are going to define how good you are as a trader, and you only use your P&L, just the absolute profit number that you generate, right, you're going to be lost, because there are certain times of the year where your skill as a trader is going to keep you safe, and it's going to avoid you losing money, which would be a direct impact on the P&L, right? But if you're getting better by avoiding bad trades, by following your plan, by using proper analysis, by building your book the right way rather than just randomly adding stuff, just by following those rules and looking back at that week and going, gee, I might not have made any money, but I avoided 25 trades that didn't fit into my plan. I missed out on a couple. That's normal. Trading plans will do that to you. But I managed to save myself from losing. Okay, that's another win, right? And I got better because I got more disciplined, and I'm more confident as a trader in that period. That's a huge victory for someone building a trading career, as opposed to, oh, well, I only made $500, so I must be a bad trader. I mean, that doesn't make any sense to me at all. You're a good trader if you follow your plan, if you avoid losing, if you don't let your ego get the better of you. And I always find P&L chasers, the guys that only focus on the P&L, and rather than your profit ratios or your win rates and your compliance with your rules, I find them a little bit ego driven. And those are the ones that have the biggest problem, because they're always chasing trades. They force trades into the market. They force trades onto their book that they might not know how to manage. Those are the guys that tend to have the biggest volatility in result. And that's what we want to avoid. So in periods like this, you want to calm it down. You want to calm your emotions. You want to look at your account, even though you're going to see massive amounts of volatility on your net liquidation value. I say to my clients, if you want to reduce the level of volatility on your net liquidation value, reduce the number of trades that you do, because the higher your cash, the less volatility you're going to have. If you spend all your money and throw it into options positions, you're going to have an NLV that looks like an ECG monitor. And then you're going to have stress levels that are going to be really high.
Yeah.
So
I don't like that much swing.
Oh, it's all a matter of personal taste. A lot of people will ask me, like, what's the optimum? I go, well, whatever makes you wake up in the morning excited to come to the screen to do your job, that's the level you need to trade at. Like, and for some guys, it might be, oh, I'm happy to put 90% of my cash at work. Some guys will be, I only want to use 20. There's nothing wrong. And I think a lot of people try and aim for this holy grail kind of absolute, this is the best thing out there. There's no such thing. What you have is a set of, like, I use multiple indicators. I have, for my clients, we use around 21. We've got I use multiple combinations of them. I use some by themselves, some with others. I use a whole lot, not because one doesn't work or three don't work together, but I'm always looking for the same confirmations. What I do with indicators is I don't trade off one. I find that one indicator will have a bias one way or the other. And sometimes the data biases can put you in a bit of a problem. So I try and look for conclusions. If I can get the same conclusion from 5 to 6 different calculations, looking at different sources of data, I have a far stronger trade than if I just used one indicator. So I don't trade off one, I trade off multiples, and I look at combinations of them. And, a lot of individuals that I work with tend to have this idea that there's one system. At some point, there's one system, and that system is the only system. And our quest that we're looking for is that, we want to find the Holy Grail. It makes me think of that Monty Python film.
Yeah.
There is no such thing. There is in trading, the only Holy Grail that you have is your ability to follow a rule. That's it. And if that rule is, I do a trade that looks like this, this, and this, then be consistent. But if you say, I do this, this, and this, and then you change your mind halfway through and you change your stop loss mentality, or you change your process for determining entry, now all of a sudden you're mixing up your data. You're not going to know whether you won on that trade because of the change of rule, or was it because of you emotionally? You don't know.
So you need a baseline. You need a baseline.
Yes.
And then you can look at it and then tweak it from there. You say, well,
absolutely.
Like all the losers, or what's common about the losers.
That's it. Because you start doing it through a process of elimination, right? So if you start with maybe 10 indicators, let's say you have 10 entry rules, and you do 30 transactions with those 10 rules, and you find that when you abide by the rules 100%, so it's tick, 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 done. If you were winning 100% of the time with the tick, 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 would you change it? No, you'd carry on until your results start to decline. And then you would look at it and go, well, that rule set now is no longer changed. Has the market changed? Yes, the market has changed. It was accumulating. Now we are distributing. Okay. So we know that in an accumulation market, these conditions work and you get 100% win rate, whatever it is. And then you'd build your next set of rules. And then as you develop this over a period of time, you might find bull put spreads work well when you've got condition A, B, C, D, and E in a market condition that looks like this. And if you've got the data that says this is your win rate and this is what you should expect on that type of setup, well, then you just sit back and wait for that setup to occur and then you trade it. Don't force the trade idea into a market that doesn't exist. And that's where a lot of guys don't have the discipline. This doesn't happen in a week. It happens over a series of cycles, right? And one cycle could be years, depending on how you trade. It could be years, it could be days, could be weeks. It depends on the time frames that you trade. So this is the biggest problem for retail traders, is that this kind of thinking is not educated. No one teaches you this. What they'll teach you is, here's how you do a long call. And they put it out there. And then, they're making money, but you're not. But you have no idea why they're winning and you aren't. And it's all this subtle stuff. It's all this non-communicated stuff. And it's this stuff that's more important. I always say to people, the thing that separates good traders from others is not their quality of data. It's not their indicators. It's not their capital. Those three things don't make a difference. Well, they make a difference in the context of they might have the ability to do bigger trades or more trades or whatever. What separates good traders from bad traders is discipline. So if good traders, if you go work in a company as a trader, you have a trading plan that is agreed by with your boss, and your job is to follow it. You have no room for error in terms of opinion, bias, any of that. They measure you on your ability to implement the plan. That's why they have robotic trading platforms. It's because the robots are going to follow the rules 100% of the time. There's
So
not going to
what do
be
you
this.
think about this algorithmic trading, these bots trading?
I think it's a great idea. I think, it's difficult to maximize the opportunity if you don't have a lot of capital, because you can't predict how many trades are going to be done. So if you've got limited capital and you're doing, let's say you only have $10,000, argument's sake, and now this is spewing out 2,000 trades a day. Like, how are you going to maximize that by taking advantage of every trade? You can't. You don't have enough capital. So what you can do, though, is you can mimic the conditions. And this is what we've tried to do in my group that I've got, is I try and understand how big money works, right? So we know that there are a large number of algorithms on the market that trade of various indicators and combinations of those indicators. So when you see a stock fall down to the 55 SMA or the 50 SMA, there's a lot of volume that starts to come back into the market. Who those institutions are and what type of capital they have. Obviously, we don't know that kind of data, but we can see spikes in volume starting to pick up at certain key points. When you have that, you can start building your own version of an algorithmic bot that works to your risk plan. So it's a question of the market's going to show you signals. Prices at some moving averages, prices are at this point, but you can build your own kind of bot by saying, okay, if the price is at the 55 and we have a stochastic buy signal and we have all the moving averages on higher timeframes are green and they, positively stacked, and we have a squeeze and we have this and we have that and we have a reversal in momentum. Once we've got all of these conditions in, there's nothing stopping you from using the same principle with your risk plan that says, I will put 1% of my account into a trade when the conditions look like A, B, C, D, E, F, or whatever it is, on this time frame, on this specific stock. It's the same thing. It's the same principle.
You just have unemotional as that robot or the computer software.
That's the thing. That's the thing. People will look at it and go, I have some clients that struggle with buying the dip. They really struggle with buying the dip because every time the stock pulls back to a moving average, they will misinterpret with their bias saying, oh, the market's selling off, it's going to zero. They don't understand that pullbacks to the mean, the 21-day moving average or the 34 moving average, are pretty normal. And in rising markets where the 8's above the 13 and the 21 and the 34, and we have that positive stack, where you've got that positive stack, if the price pulls back to the mean and the prices are still positively stacked, that's a healthy pullback. That's normal, that's expected. And those are opportunities for unemotional buyers to go in and build their positions. So when you're not trading a plan and it's just randomly adding stuff to your book, you overcomplicate the management process of your book later on, because now you've got too many trades. You don't know why you did this one. You don't know why you did that one. One of the challenges that I have is that I trade every single trade that I give my clients. I'm doing it with real money. So my book tends to expand based on how many opportunities come out, and it tends to shrink when the opportunities aren't in. So I trade with a book that's far bigger than I would ideally want to trade. So I have, between 60 and 70 positions, but I look at it and I go, but I'm sitting here all the time. I've automated a lot of the controls on my positions. I plan them all. My trades are automated to the close. So when the stock hits a particular price, the trade gets closed. So I don't really have to worry too much about the intraday management of it, because you can automate a lot of that. But for some clients, they don't have the patience to do it. They don't have the toolkits to do it. So they should just be trading smaller positions. And if they've got a clear filter mechanism that says, I'm only going to trade the following 20 stocks, be it sectoral ETFs, for example, or any one of the top 10 stocks within those ETFs, they have a finite list of opportunities. And when you only have to look at 20 stocks a day, the end of day analysis and preparation for the next day's trading is very, very quick. But most people are not disciplined enough to do it. 15, 20 minutes a day, it's not that hard. What people are always attracted to is this, the upside on this is unlimited. And it's, you're going to make 5,000 times your money,
It's like a workout program. It's like, why work up a sweat for 15 minutes when you can just put this little electronic TENS unit on your abs and sit there and get shredded, Chris.
When I was 19, I put one on and it didn't work. No, and it's such an important piece of the psychology of trading, is that you have to control your expectations to the point of looking at what can be consistent rather than one-off. Because 90% of the time you make a one-off gain where you've got this, a windfall, let's say, on a trade, within 6 to 8 months, you'll give it back. We don't see these memes getting posted of people who scored on that huge GME run earlier this year. We should take a survey. How many of those people held on to those gains? How many of those people who made money on Dogecoin gave it back? I would just be interested to see the extent to which people give that money back, because there are some social studies that have been done on lottery winners, people who've won on the lottery and then within 6 years they broke again and living on the streets. It's because
there may be a research study coming out on trading, just because it's so new. I've seen a couple of studies, actually, that looked at the psychology of gambling and how this retail, how it fit the model of some of the retail trading that come up with the apps.
Well, a lot of it's now gamified, right? Even the colors, when you think of the colors that are being used on screens, like the green and the red, it's very similar to a roulette wheel. There's some sort of psychological thing to the colors. I'm not an expert on this, but all I can look at is the experience I've had with normal retail traders who've wanted to be good traders over the last couple of years. I see the same thing. People have unrealistic expectations of themselves. They see the entry to trading, or the barrier to entry to trading, is capital, right? This is sort of my theory. Capital is not the barrier to entry to trading. It gets you in the door, but it's not a requirement. If you're smart, you can trade often with very little capital. So capital's not necessarily the thing that makes you a good trader or not. So if you come in and you've got a load of money, it doesn't make you a trader just because you got money, right? Money doesn't define the fact that you can trade or not. I've seen a lot of rich people lose a lot of money doing stupid things. There's no correlation between trading ability and capital, right? There isn't. It's totally disconnected. And what happens with a lot of people, that especially if they come in with, 6-figure kind of capital starting, capital balances, is that their expectation is, because I've made money in the past, this should be a walk in the park. And I don't need to have a plan, or I don't need to do that. Chris is being too, you're adding too many pieces of complexity into this. And what they don't realize is those layers of complexity are protective. They're protective of your time in trading. I would much rather have someone take it slow. And I usually encourage this process. Take the first 6 weeks to paper trade your personality. Don't just paper trade trades, paper trade your personality. Understand how you react. Now, it's not the same with money. The emotional connection to paper trading is, you can oversize till you're, blue in the face. It's not going to have the same emotional connection to a trade when you paper trade. What you want to do is determine your ability to follow rules. And I usually do that with a lot of clients. I want to see if they're disciplined enough to follow the rule of the next 30 days paper trade. It's a rule test, because usually when I say to clients, paper trade for 30 days, they've come to me because they've started trading already. Now you want them to stop and see if they're disciplined. And 98% of the time, they don't stop. I don't need to do that. That's a beginner thing. I'm already experienced. I'm a trader. And that's what happens. And I can almost predict, if you don't follow that rule in the first 30 days, your first year is going to be a lot harder than the people who actually follow the rules. And it's crazy accurate. And usually the people who don't follow that rule will quit trading within 2 years, because they will never develop the discipline to be consistent, because they can't follow rules. They've already demonstrated their ability not to follow rules. So, you start picking this up over time. If someone comes to me and they're already a trader, I say to them, this is how I teach, paper trade for 30 days. And they go, but why do I need to paper trade? Because I'm already trading. I know how to do this. I go, well, if you know how to do it, then why are you with me? Because then you don't need me, because you already know how to do this stuff. But they demonstrate their inability to connect to the rules. The rules are so important. Your trade setup and your rules and being disciplined in following it, that will make you a good trader. Not just, which indicator do you use and what stocks do you trade and which chat groups you are on. Those things are superfluous, absolutely superfluous. It's how do you follow the rules? So hopefully someone who's watching this, who might be sitting there and they've read up and, oh, paper trading or whatever, how important is it? I still paper trade. After 20 years of doing this, I still paper trade. There are techniques that I try and master. There are combinations of indicators I try and do on setups. You have to do it. It's like professional tennis players going onto a tennis court to practice. Djokovic doesn't go onto a Grand Slam match without having warmed up. Paper trading is your warm-up. It's your opportunity to test
like drilling and learning.
Yeah, it's like, jiu-jitsu. We don't just go in and say, hey, I watched 5 UFC fights. Can I go and compete? It's like, it's not going to happen, man. Yeah, so it's such an interesting part of how the world is changing. Trading is becoming so much more a part of young people's vocabulary. The amount of young people that call me, that want to join in my program is amazing. Because, you get these guys coming out of school and they're realizing like, oh, maybe I don't need to go and work for some douchebag, and, maybe I can make this. I've got one client who's a 16-year-old kid. He doesn't live in North America, lives, 9 hours ahead of us in the time zone. And he comes home after school on a Wednesday and he sits with me for an hour and a half and we trade together. And, he's learning it as a 15-year-old, 16-year-old kid, as a potential life skill for later on. I mean, it's amazing what his parents are doing for him. And it's that kind of mentality that sets you apart. It's those kind of guys that are going to make it work. So hopefully there are people out there where this message resonates and they can see it. It's an incredibly rewarding thing to do, but you got to do it well. It has a completely different connotation if you screw it up. So you got to...
absolutely. It's frustrating. If it can be frustrating. I've been frustrated, and I don't quit things though. That's the one thing. Like,
the thing that you've got to remember with this is you've got to be able to isolate the source of frustration. So if the source of frustration is a matter of inability to interpret data, then we fix the ability to interpret data. If it's an emotional issue about oversizing, we fix that. The whole thing about trading is you've got to know what the problem is in order to fix it. If it's just, I hit a bad streak and I've had 7 losses in a row. Okay, well, that happens to everyone. So what are you doing about it? Oh, I'm just going to carry on doing the same thing. Well, no, you hit that losing streak for a reason. Did you not recognize the market condition had changed? Were you using the wrong strategy on the wrong stock at the wrong time? Were you using the wrong strategy on the right stock? So you got the stock right, but not the strategy. Which one was it that got wrong? If you're not analyzing it to that level of detail, it is so difficult to get out of a slump, because then you start questioning your rules, right? You start going, well, this obviously must be wrong because I hit a slump. Well, maybe your rules were right, but you weren't disciplined in following them. Now you start changing things up. You say, oh, well, I'm going to ditch this signal because that's crap. Meanwhile, the signal might have been perfect. It's just you oversized it and timed it wrong. You entered on the wrong chart at the wrong time, and the trade worked out, but you did it wrong. I mean, I had that yesterday. I followed my signals. I had my exit rule at 3:30. I lost the trade. If I'd held on for an extra 30 minutes, I would have made 100%. So I look at it and I go, sometimes those rules are going to get you on the wrong side of the trade. So I went back last night, looked at my rules, made a bit of an adjustment, and that's what I'm going to do tomorrow. It happens to everyone. Like, there's no person on the world that has no problems when they trade. Every single person has trades. You've just got to know what they are so that you can fix them, rather than just randomly saying, oh, I'm a crappy trader. Well, you might be a brilliant trader that's just doing some crappy things. If we change the crappy things, I was always taught you're a couple of trades away from changing your account. That's the way I see it. And the more you trade, the easier it is to find those opportunities that are going to change your life. Now, if you don't have a rule set or a filter that allows you to pick opportunities, you won't know when the life-changing trade is going to come around, because you're just randomly adding stuff. You're following a meme stock. I mean, not all meme stocks go like GME. Not all of them are going to do that. But, if you had a filtering mechanism, you can certainly tell the difference between ones that have got potential and ones that don't have potential. You're not going to be chasing the wrong thing. It's like someone who's completely dedicated to just triangling their opponents, and then they get stuck at the bottom of the mount, and then you go, well, what are you going to do now?
You need more tools. And
absolutely. And it's 90% up here in your head. It's how you treat the tools. It's how you can meet jiu-jitsu guys that are fantastic at 1 or 2 submissions, but they've got an arsenal of 100 more that they might not be as good at, but they still can do them. They sort of 50 to 60% on a lot and 150% competent on 3 or 4.
They recognize the opportunities when those things will fit into yeah.
It's knowing when to use the tools you're good at. And that's where your rules come in, because your rules will determine the optimum timing for things. When this happens, when this happens, when this happens, when they all align, you have an opportunity. When you've got, this type of setup, I communicate that to my clients a lot, because I'm always testing new setups. And I'm very aware of, if I enter a trade specifically, this type of strategy at this point, when I've got this, this, and this, I have an 82% win rate on those trades. So when I search and I'm looking for that setup, it only happens, the other day I only had 8 trades that came out of a market of 5,000 to 6,000. When you start looking at all the options and all of that stuff, you might have many, many, many alternatives. My one screener allowed me only to identify 8 stocks that fit into that category. And out of those 8 stocks, I only did 1 of those trades. So it's the ability to find exactly what you're looking for. That's the key. It's not a matter of how much money do you have. Regardless, it doesn't matter how much money you have. You can be a great trader with a little amount of money. Like, you don't need a lot. So hopefully someone out there is sitting there and it's going to trigger something and they're going to go, that makes sense. I'm going to give it a whirl.
Now, this is great psychology stuff. I think a lot of people get caught up in the technical and forget about the planning and the psychology of the whole thing.
You got to keep your brain controlled, man. Your brain is your worst enemy. Yep. The way you talk to yourself, the way that you define yourself as a trader, if you're talking to yourself, if you say things like, I'm a shitty trader because I did this, no, your brain is going to then get you into the sort of subconscious mode of trading to be shitty, because it can't tell the difference. Your brain cannot tell the difference between things you say to yourself that are real and things that are not real. It can't tell the difference. Yeah. And you've got to remember that. And as a trader, it's an incredibly important thing to remain positive, regardless of what's going on around you. When the market goes the wrong way and you've got trades that went the wrong way, okay, kill the trades. Just kill the trades, follow your rules. Don't hold on to them. Don't hold on to dying trades in the hope it will turn around. Kill the trade, follow your rules, and get out. And don't look at it and go, oh, I'm a bad trader. And don't say, oh, the market went against me. Like, there's nothing more irritating to hear a trader go, the market went against me. Market didn't go against you. Market doesn't care that you're there. Doesn't even know you're there. In fact, it doesn't sit there going, I'm going to screw you over today. It doesn't do that. The market doesn't have a rat's ass about you. It doesn't care. So what you've got to recognize is, what did you do wrong? Did you miss a signal? Did you not set an exit alert to get out of a trade when it failed? Did it fail because of market conditions you failed to recognize? If you know the problem, fix the problem. But don't put it on you and go, oh, I'm a crappy trader. That's ridiculous. No one's a crappy trader. They're just ill-disciplined. But then the discipline comes from knowing what you need to fix. So
yeah,
just like in anything, you can't be good at jiu-jitsu unless you know what you're bad at.
Yeah, fixing your weak links. That's a pretty common thing, I think, that for learning anything, like recognizing.
It's the part of life in anything you want to be good at. If you're constantly telling yourself you suck at it, I can almost put money on you're going to suck at it.
Yeah, the self-talk is huge. Self-talk is huge. Like,
I'm a big believer in it, because a lot of retail traders put too much effort into, or too much emphasis on themselves to meet and beat the expectations or the performance of professional traders. Since when is it appropriate to benchmark your ability in anything with the world's best? It's not going to happen. So if you're sitting back as a retail trader who's only just started trading, and you're comparing your P&L to someone who's been trading for 20 years with, all this capital and experience, this DNA that they have because of all this experience that they've got, that's crazy. you can only benchmark against yourself, number one. And number two, you benchmark against your ability to be compliant with what you've said you were going to do. So if you don't do that and you don't know what you're supposed to be doing and you're just randomly adding rubbish to your portfolio, I'm not surprised people lose. Really, it doesn't surprise me at all. When people call me and tell me that they blew up their account selling naked puts on rising stocks that failed and fell back, I'm like, but at what point did you think it was going to stop? Like, just so that I can understand if they know when things start to shift.
Yeah.
And the immediate response that I get 90% of the time is, I didn't know that I could do that. And I go, but come on, it sounds illogical that you would think that that would continue to be the case going forward. The amount of people that got wiped out when Bitcoin corrected, when Tesla corrected, when all of those things that were trending strongly suddenly reversed on them. I'm like, what killed you was not the fact that you used the wrong strategy at the wrong time. It was your greed to think that everything was going to be maintained for the rest of time. And you didn't actually ask the right questions. Like, what's the market doing? Is this the most appropriate strategy to be using on a stock that has been extended for weeks? It was trading at such elevated price levels. You know, when you think about, you know, GME, there's still some poor sucker who paid $480 for that stock. You know, why did you do it? It's not a question of, was it wrong? I just want to know why, what motivated you to do it. And 90% of the time is FOMO. People get FOMO. They're like, oh, don't want to miss out. Yeah, but you didn't look at anything that would have told you that was a bad idea. You know, so
right.
It's all about that plan. It's all about your head. It's all about managing yourself. You know, it's such an important part, way more important than anything else. You know, keeps you safe.
Absolutely. Great words of wisdom, Chris. Hopefully they're going to help out some people. If you want to check out Chris's program, Alpha Hunters, go over to Rogue Investing /alpha and join up and start learning. So appreciate your time, Chris, and we'll see you again next week.
Talk to you soon, my friend. Awesome to see you. Take care.
All right.
Bye.